Hello guys, my name is JT. In this video, I'm going to talk about Alibaba. Alibaba's share price has been under pressure in the recent days, ever since the suspension of Ant Group IPO. It has bounced back up from a low of 245 USD to about 270 USD recently. So, is it the right time to buy the share now? Many may not think so, but fundamental analysis seems to tell us we should. Let's find out more from fundamental analysis. Alibaba Group is a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. Founded in 1999 in China, the company provides C2C, B2C, and B2B sales service via web portals, as well as electronic payment services, shopping, search engines, and cloud computing service. It owns and operates a diverse portfolio of companies around the world. A few key facts about Alibaba. On 19 September 2014, Alibaba's initial public offering raised US 25 billion, giving the company a market value of $231 billion. And by far, this is one of the largest IPO in the world history. It is named the 31st largest public company in the world on the Forbes Global 2020 list. In January 2018, Alibaba became the second ASEAN company to break the US 500 billion valuation mark after its competitor Tencent. As of 2020, Alibaba has the sixth highest global brand valuations. Alibaba is often referred to as the Amazon of China because of its growth trajectory being nearly identical to that of Amazon. Both companies started off as e-commerce platforms, but over the years evolved into much more diversified companies with a significant focus on technology. Alibaba comes under the limelight after Ant Group IPO being suspended. Ant Group was set to go public via a dual listing on the Hong Kong and Shanghai exchanges to raise nearly $35 billion. The regulators' last-minute delay came a few days before the official IPO, with Chinese regulators proposed anti-monopoly rules. All the things that allowed China internet innovators to become big, powerful, and hugely profitable are under threat. The implications are chilling for established players. Draft rules detailed by China antitrust watchdog are aimed at rooting out monopolistic practices among internet companies. So this poses a great challenge to assistance of the company, driving the share price down across the board. But it doesn't matter. Alibaba is still a good company for a long-term investment, and fundamental analysis is going to tell us why. For a better evaluation, we need to compare Alibaba with its closest competitor. One won't be able to tell this apple is good or not until there is another apple is placed side by side, just like this. Looking at the world today, it is only fair to compare Alibaba with Amazon, as both has such a similar business model. The two seems to share quite a bit in common. The two e-commerce who enjoy the luxury of a very few competitors. While their market shares may be different in percentage, Amazon owns about 40% of US commerce sales, while Alibaba owns about 60% of the all retail e-commerce share in China. They each dominate their respective countries in which they began. Both also has proprietary payment system. Amazon has Amazon Pay, which allows users to purchase items on non-Amazon sites with their Amazon accounts. Alibaba has done the same with Alipay. with more than 700 million annual active users employing its mobile and online payment system. The first KPI is annual revenue. Please note that Alibaba has a different fiscal year than Amazon. Amazon's fiscal years end on December each year, while Alibaba ends in March each year. For simplicity's sake, I put their closest revenue into the same year for easier comparison. Revenue is usually referred to as top line of the income statement. According to Investopedia, revenue is the income generated from normal business operations. It is an extremely important metric when analyzing a company. A strong year-on-year revenue growth is usually the attribute of a healthy, strong company that delivers great value to its shareholder. And this is the case for both Alibaba and Amazon. Alibaba's revenue is just about 26% of Amazon as of 2019, which is comparatively much smaller. So we are talking about a knight challenging a giant. It is not so dramatic. They are not that far off. So probably we can say that we are comparing a younger sibling from China with its big brother who is 5 years older. Just for the record, Amazon is established in 1995 as an online bookstore, while Alibaba started its venture in 1999. So are they growing at the same rate? The answer is not. Based on CAGR estimation for the past 13 years, Alibaba is growing at about 2 times faster than Amazon. Let's assume both continue to grow at the same rate in the subsequent years. We will be looking at Alibaba matching the revenue of Amazon in the next 8 years' time, which is impressive. Of course, in reality, it is most likely not the case because the bigger you get, the harder it is to grow as the base is larger. Let's look at profitability metrics. First is the profit margin. Profit margin is one of the gauges to know if a company or a business activity makes money. It represents what percentage of sales has turned into profits. It is calculated by dividing net income with revenue. Comparing the same period from 2013, average margin for Alibaba is 28%, while Amazon is just 2%. With each margin at 31% and 6% as of June 2020. Averagely, Alibaba is earning about 14 times more margin than Amazon in the past 6 years, with quarterly margin performance in June 2020 5 times better than Amazon. Second is a free cash flow. Free cash flow represents the cash a company generates after accounting for all cash outflows to support operations and maintain its capital assets. The formula is free cash flow equal to operating cash flow minus capital expenditures. On the backdrop of just a quarter of Amazon's revenue, Alibaba is generating consistently higher free cash flow than Amazon year and again since 2014 in quarterly result. This is an amazing achievement. As of September 2020, Alibaba's quarterly free cash flow standing at 29 billion, while Amazon who is at 24 billion. Alibaba is a monster cash cow, and imagine what it can generate when it reaches the same level of revenue as Amazon. Now we go for return on asset. According to Investopedia, return on asset is an indicator of how profitable a company is relative to its total asset. ROA gives a manager, investor, or analyst an idea as to how efficient a company management is at using its asset to generate earnings. Return on asset is displayed as a percentage. The formula is to divide net income by total asset. As of June 2020, Alibaba is again beating the performance of Amazon by delivering 14% of ROA as compared to Amazon or 6%, which is more than twice as much as Amazon, despite being a smaller company by revenue. Now let's look at liquidity metrics. Current ratio. This is the only ratio that we're going to look at to simplify the analysis. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within a year. It tells investor and analysts how a company can maximize the current asset on its balance sheet to satisfy its current debt and other payables. The data shows that Alibaba is consistently having higher current ratio compared to Amazon from 2014, which is a recent current ratio at 2 compared to Amazon, the ratio of 1 consistently over the past 6 years. It implies that Alibaba current asset is double their current liabilities, while Amazon's current asset is just enough to cover their current liabilities. Now, leverage metrics. The debt to equity ratio is calculated by dividing a company's total liabilities by its shareholder equities. These numbers are available on the balance sheet of a company's financial statement. The ratio is used to evaluate a company's financial leverage. The D/E ratio is an important metric used in corporate finance. It is a measure of the degree of which a company is financing its operation through debt versus the wholly owned funds. More specifically, it reflects the ability of shareholder equity to cover all outstanding debt in the event of business downturn. Alibaba again beat Amazon in this metric, having just 0.2 compared to Amazon at 0.4. The last metric is market metrics. Market metrics relate to ratio that include price as part of the calculations. And here we are talking about PB and PE ratio. Let's start with PB ratio, with Amazon standing at 19 as of November 2020. The PB ratio measures the market valuation of a company relative to its book value. PB ratio is used by value investors to identify potential investment. A lower PB ratio is favorable as it is perceived as a good investment. Alibaba's, on the other hand, has close to 6 in November, making Amazon's 3 times higher PB ratio than Alibaba. Now we look at PE ratio. The price to earning ratio or PE ratio is a ratio for evaluating a company that measures its current share price relative to its per share earning or earning per share EPS. A lower PE ratio is favorable as it is perceived as undervalued. Amazon has a PE ratio of 91 in November, which is high when we compare to Alibaba. Alibaba's PE ratio is just 1/3 of what Amazon as of November 2020. Let's summarize the fundamental analysis so far. Other than revenue, Alibaba's excels against Amazon in all ratios that we are competing. So how is their share price performing then? Amazon's share price has a whopping 11.5 times higher than Alibaba as of November 2020. So what's going on? Why did Alibaba, after winning all those fundamental analysis ratios, their share price is less than 10% of Amazon? Some said it is because of people doesn't know Alibaba well enough. Some others said it could be due to Alibaba's ADR causing major funds not investing into the company. There could be a way to explain using data. but it may not be a conventional way. To know it better, let's look at free cash flow table again. Recap of free cash flow. Alibaba is earning higher free cash flow than Amazon despite being 4 times lower in annual revenue. When we look at free cash flow per share, Amazon is 5 times higher than Alibaba. This is because Alibaba has extremely higher share outstanding at 2.7 billion compared to Amazon only at about 0.5 billion, more than 5 times higher than Amazon. Again, it is probably not a conventional method to evaluate the share price, but let's assume same number of investors invested equally to both companies. Amazon with its significantly lower share outstanding is going to drive the price higher, a simple supply to and demand scenario. This is where it stands right now, at one point of time in November 2020. Please note that the share price is ever changing and we are using this number for calculation and illustration purposes. Now, assuming we increase Amazon number of shares outstanding to match Alibaba at 2.7 billion. Due to higher demand in share offered, its share price would naturally go down accordingly based on the scale of increase in share. That means with higher shares released to the market, the price of Amazon will naturally reduce according to the same scale. By dividing Amazon's share price of $3,098 with 5.4, the calculated share price is $573 US. Compared to Alibaba's price of 270, its share price is still considered undervalued. It is just less than 50% of Amazon calculated share price of $573. With Alibaba's strong financial performance, their share price is definitely undervalued as it is likely they will match Amazon's share performance over the long run. Thus, I have added the last matrix to the bottom of the table, which is share outstanding. The recent quarterly report as of September 2020, again showing a continuing strong revenue growth of Alibaba. Revenue growing at 30% and cloud computing even growing higher at an impressive 60%. There is no indication that their growth is going to slow down by anytime sooner. From the results shown in the fundamental metrics, Alibaba is definitely a buy. However, the major potential risk is the intervention from China government, which is a factor that we could not foresee clearly in the data. It is important to note that these are fundamental analysis and it is really fact-based analysis based on historical data. Please do your due diligence before investing to the stock or any stock. I am not a licensed professional, just to note. What I'm showing you is from my own analysis. Please don't invest just because JT said so. This is not a recommendation to sell or to buy any of the stock. I hope you can use this information to kickstart your own research. Thank you so much for watching and thank you so much for your time. If you guys like the video, make sure you hit the like button and subscribe to see more video just like this. Thank you.